Good evening, everybody. Thanks very much for joining us. This week, I want to take a look at charting commodities, and in particular, look at Fibonacci retracements and how we can apply Fibonacci retracements to look at a couple of commodity markets. Now, previously, I have done a previous video on Fibonacci's where I went into the use, how they're applied, why we use certain retracements. For anyone that didn't see that, I'm just going to leave this slide up for a couple of seconds. But if you do take a look back in the Plus500 video library, you'll find that the Fibonacci retracement basic video is available to view. So I just recommend that you take a look at that just to refresh your mind, or just take a closer look at how we can apply Fibonacci's in our day-to-day analysis and trading. So Fibonacci's and commodity markets. Well, obviously, commodities have been quite volatile of late, and this isn't quite an ideal opportunity to apply Fibonacci retracements, because when we see sharp corrections within market activity, it's quite often a Fibonacci retracement that will act as a support or resistance level, depending on the direction of the move. So if we take a look at oil on a weekly basis, and the move that we saw into the March highs last year, and look at how we applied Fibonacci retracements within this type of backdrop, and what the market was telling us in terms of price movements. Well, when we look at oil and when we look at Fibonacci's, we need to establish the significant high and significant low. And it's pretty obvious where these points stand out in terms of market activity. The November 2020 low was a significant recovery point, and each time the market made a new recovery high, we would recalculate the Fibonacci retracements until we get back to an eventual significant peak from which the market extends and sees a more prolonged decline develop. So if we were to run the Fibonacci's on this from the significant low in November 2020 to the significant high in March 22, we'd get the 38% retracement level at 93.46, the midpoint or the 50% level at 82.20, and the 62% retracement at 70.75. So how did these Fibonacci's play out in terms of acting as a support level to any corrections as a reaction to what was a very significant and very sharp acceleration period? Well, when we look at price action, the initial sell-off from the March highs did find support from the Fibonacci, 38% Fibonacci retracement. And we would expect, if this is an ongoing positive trending condition, this 38% level to limit downside and prompt recovery. And that is what developed in oil into the June highs. Now, this was significant because when we look at price activity, if we're expecting an ongoing bullish trend to continue, then we would look for a break of the previous high, further extension to new upside extremes, and we would then recalculate the Fibonacci retracements. However, what actually happened in June was that the market failed to break above the previous peak. We saw a lower high, or a weak test of the previous extreme, which was showing weakness within the bullish trending condition. The market then sold off and broke below the 38% retracement support. Now, this was important because it highlights deterioration within the market. It doesn't give us a signal that the market has necessarily topped out, but what we would anticipate with a break of a 38% retracement level is a move towards the midpoint, which in the case of oil stood at 82.20. And you can see that the initial test of this midpoint level resulted in a bounce and a period of consolidation. But the upside failed to attract any significant support, and then sellers resumed, saw a close below the midpoint level, which again was further indication of deterioration within the market and the risk of a more extended sell-off down towards the 62% level, which in this case was at 70.75. We did actually see a reaction to the initial downside move, and the market bounced back. Now, we would be ignoring this retracement point because this was calculated off these levels. But if we'd actually drawn the retracements from this peak to this low, this was a 38% retracement area from which the market failed and then reclosed below the midpoint level to trigger and expose risks down towards the 62% level at 70.75. And this is actually where we stand this week in terms of price action. This is reasonably up to date for a couple of days ago. But you can see that the sell-off found support at the 62% retracement, and the market has entered into a consolidation period. So this now means that we need to take a closer look within price action. And if we look at the daily chart, we can run shorter term Fibonacci retracements to give us a feel for what is actually happening from a shorter term perspective and whether or not we're starting to see important resistance levels give way in terms of the retracement points. So if we take as significant highs and significant lows, the August 30th high, together with the December 9th low, and run the retracement levels on this downside move, you can see that this week, 80.64, which is the 38% retracement, the first retracement point and first focus for a potential failure, or if we close above it, then the potential for a more extended move higher. And actually what has happened this week is that the market is now attempting to close above this first retracement, which is reflecting more positive themes for oil and the potential for a more extended move higher. And we can then use Fibonacci retracements to gauge where the next resistance levels are. So oil looks to be breaking through its first retracement level. What about copper and Fibonacci retracements? Well, this is the longer-term weekly chart of copper. And if we take the April 5th high together with the July 15th low and use these as the significant high and low on which we're going to calculate retracement points, we can see that the retracement levels have highlighted trigger points within the market, i.e. when we start to break above them, we see acceleration phases. And this is up to a couple of days ago. Last week, we actually started to break and close above the 419.58 62% retracement, which was a positive way to end the week and reflect the potential of a more extended move higher once more. Now, it's important that we look at Fibonacci retracements over different time frames. And if we, for instance, had looked at this move higher from the July 15th low into the November 14th high, trying to highlight the support points offered by the retracement of this upside move, it was interesting that the midpoint or half of this upside move at 355.06 limited downside and prompted fresh acceleration to the upside, maintaining the positive themes. So we're not only looking at the retracement levels back to the upside, we're also looking at downward retracements to highlight the potential support points and areas where if we're starting to continue to see more positive themes, levels which we might consider using as a support and an area that we could perhaps be looking to use as a buying opportunity, to use weakness as an opportunity to get long ahead of the risk of further upside. And as I say, the break and close above the 62% retracement has left a more positive backdrop for copper. So now what we would actually do is look at the shorter term daily chart and run retracements on the latest upside move. So from the January 4th low to the January 13th high, and gauge where the support levels are actually developing. So earlier in the week, we were looking at 402.89, which is the 38% retracement level, as a potential support, an area if we saw a correction after this strong acceleration higher, that would act as a support point and a potential bounce level to resume more positive themes. So we always go into the market knowing where the potential and important support or resistance levels are, depending on the direction of the trend. And we have that in mind when we're structuring our trading ideas. We may not want to chase prices higher to get long of a market. Rather, we might want to wait for a correction, and it's Fibonacci retracements that are ideal in highlighting those supports and areas where we can anticipate a resumption of the longer-term positive themes. Now, what has actually happened over the last few days is that new highs have been posted in copper. And this means that we need to recalculate these retracement levels. So it's a good opportunity for you to take a look at your Plus500 system, get a chart of copper up, and just practice running those retracement levels to gauge where the next important supports are and areas that we should be focusing on as a potential hold level, and that can resume what is still a longer term, more positive theme, because we know that we've broken above that long-term 62% retracement resistance level over the course of the last week. Thanks very much for listening. I'll be back in another couple of weeks when we'll look at something else within technical analysis. Thanks for listening.